I would now like to welcome Craig Lowrey, our senior consultant, to and I should know that, and regular forum contributor, who is going to give us his insights on the series of policy initiatives we've seen over recent weeks, the preparations for COP26, and an immediate reaction to the UK budget that was presented yesterday, the 27th of October. So if I can hand over to you, Craig, please.
Fantastic, Robert. Thank you very much. Yeah, I think just in terms of, we'll just skip the very quick summary slide. Yeah, just to reiterate what Robert has discussed in terms of what we'll be looking at. But yeah, kicking off first and foremost with the headline announcements from the net zero strategy. Very much a long-awaited document, and so in looking at the respective pathways for the different sectors of the economy, or the different primary contributors to emissions, you can see from the graphic that it's perhaps the inevitable focus on transport, domestic transport, heating, and I guess probably to a lesser extent agriculture as the primary contributors, expected contributors to the UK's emission reduction target and the move towards net zero by 2050. In terms of the high level indications, I mean, you can see there the objective to work with and to help facilitate consumer choice as far as emission reductions are concerned, and that's highlighted certainly in a couple of the points in the net zero strategy, particularly those relating to heating and to hydrogen usage in the economy. There's also the focus there, as one would expect, to ensuring that the more vulnerable consumers are protected throughout the transition. Continuing with the polluter pays principle, which has dominated government thinking, with emissions reduction, I guess really for the better part of the last 25 to 30 years, if not longer. And working alongside the private sector to develop and implement low carbon technology solutions. So looking then at the 5 key pillars of the net zero strategy, first and foremost, the power sector. There was already the 2050 target for a full decarbonisation of the power sector. That's now been accelerated to 2035. Noting that there is a comment there which says that everything is subject to security of supply, which is certainly very pertinent.
So do you think that's a bit of a get out?
Yes, I do think it's a bit of a get out, and the fact that the questions that we've had over the last 2 to 3 months relating to wholesale price movements and precisely the causes there. I do think that's a little bit of a means by which the government can say, well, if we do have to keep certain assets on the grid to help maintain supply security, then we will. I mean, there's no specific definition as to what supply security is in this context, but you'd think you'd be looking at some form of loss of low probability or equivalent, such as what we have for the capacity market, etc. But yeah, so that's first part, and looking to continue and develop customer engagement throughout this process. For the heating and building infrastructure, very much focusing on minimizing holistically the cost of decarbonisation of heating buildings, looking at the low-hanging fruit where they haven't been tapped so far. So specific targeting of certain buildings or types of buildings or certain sectors. And also trying to, throughout this process, where possible, looking at future-proofing the solutions which are implemented, so essentially you aren't having to go back and repeatedly retrofit or redevelop certain buildings. For hydrogen in general fuel supply, it's interesting actually looking at some of the statements that are in there for hydrogen. And that its usage is very much dependent upon what happens to the other means of decarbonisation. So I mean, it reads like it's more filling the gap that's left by other technologies, and/or where those technologies aren't viable. And there's specific scenarios that the government's put in the net zero strategy for the use of hydrogen. So depending upon the viability or not of other technologies, and effectively the extent to which hydrogen is or is not needed to step in and fill that particular gap. Transport. I mean, a lot of what we're seeing for the transport technologies is that it's more of the same, if you will, looking to further build upon the existing technologies, or technologies which have been scaled up to meet the existing targets or more accelerated targets, as the case may be. But looking at continued deployment of market signals where possible to facilitate that, rather than, I guess you would say, excessive reliance or reliance full stop on legislation or state-backed initiatives where possible.
So does that mean more funding for stimulating domestic production of EVs? Because there's quite a lot of that was pushed forward yesterday in the budget.
Yeah. I mean, I know like we'll get out of the budget, but I can't remember the exact number off the top of my head in terms of the additional funding that was
about $1 billion.
About $1 billion, yeah. It was just shy of that, I think. Like over and above what had already been announced. So there's very much the focus there on improving domestic supply chains for the EVs and so on. But obviously that's on top of what was already announced within this document. And yeah, so the fifth one, greenhouse gas removals, have already been highlighted by Ofgem. I mean, unlike, I guess, the other four pillars, because this is still very much early days in terms of the technology, or a large-scale application of the technology. It's very much focused upon proof of concept and trials to see what can actually be achieved in the area. Yeah, so they're the 5 main pillars, and we'll look at each of these in a little bit more detail now. Starting off with power. Yeah, the issue of affordability is very much front and center in what's been announced by the government in the strategy. The issue of continuing to promote customer engagement in the sector is also highlighted. I mean, I think it's interesting. I know we'll come on to this as far as suppliers are concerned, but historically engagement has very much been based upon customer switching. I guess that there's an argument as to what customer engagement in the energy market will look like in 5 years or 10 years time.
Yeah, this is particularly if people have to decarbonise their heat.
Yeah.
They're going to have to spend, or somebody's going to have to spend some money on some new infrastructure to do that. And
very much so.
That doesn't really lend itself to, in the context of the business market, 1 year, 2 year, even a kind of 5-year flex contract.
No, very, very much so. I mean, I think you look at the anticipated cost of we'll come on to, but like of some of the heat pumps or boiler alternatives, and it doesn't lend itself to
no,
like a 1, 2, or even 3 year business.
No, because we're shifting to a capital intensive rather than fuel intensive sources.
Yeah. So that's certainly part of the debate which needs to be resolved.
It's also slightly ironic, isn't it, Craig, that we're here talking about affordability, where the tariff cap is providing some short-term relief to the domestic consumer from what it might otherwise be, but at considerable costs on the supply side.
Yeah.
And as we've been hearing this morning and over the last 2 or 3 weeks, pleas from industry for relief from the current very high spot prices seem to be falling on pretty deaf ears.
Yeah, I mean, it was interesting actually listening to the budget yesterday and reading the main documentation. That there's like a 1 or 2 line comment about the price cap. And I think that actually very early on in his speech, the Chancellor was essentially saying, it's not the role of government to continue to step in and provide support. It's perceived to be something of a knee-jerk response that is the call. But no, I think you're absolutely right. The issue of additional support, well, sorry, I say additional support, any support for businesses seems to be very much falling on deaf ears as far as the government is concerned at this point.
Sorry, I made you lose your thread there.
I feel like we're sitting here as the harbingers of doom, which is not our intention. Yeah, the low carbon electricity supply by 2035, again subject to security of supply, and that particular get out of jail free card, whatever that's going to look like. New flexibility measures. There's the given the expected increase in renewable deployment, intermittent renewable deployment, then there's going to be a need for additional storage capabilities. There's also comments in the strategy about looking at the needs for longer duration storage as well. So I think that's quite interesting. Now, one of the things that I keep coming back to with this is that, I mean, we do keep talking about electricity storage, but I think that there's still very much an argument for looking at gas storage. I mean, in the context of the document, it's very much looking at the potential of hydrogen storage and its wider implications. But I do think, speaking from a personal perspective, gas storage.
An old gas man speaks.
Yes, indeed. Yes. Yeah. I'm showing my history in the industry now. But yeah, I do think that there's still merit for that. The 40 gig of offshore wind, that's very much a long-standing target. The issue of the CFD review, we've got the fourth allocation round is sorry, I was going to say next month. It's December. I'm getting ahead of myself in my calendar. To make sure that that's still that is continuing to be fit for purpose to support investment. The idea of supporting carbon capture utilization and storage plant through what's called the dispatchable power agreement is something that was announced previously by government. I mean, effectively, it's as it was originally pitched, it's a minimum 10 but typically 15-year mechanism to encourage or to help support CCUS plant to operate and compete effectively in the merit order, and that's through a payment mechanism for the relevant generators to be recovered from consumers. So it's sort of a pseudo CFD. But a very targeted one for CCUS assets. Final investment decision on new large-scale nuclear by 2024, which is the end of the current parliamentary session. That to be delivered under regulated asset base, which is I think that got quite a lot of column inches when it was announced on Tuesday, yeah, this week.
Yeah.
I think it's actually very, very controversial.
The big difference with Hinkley Point C is that consumers start to pay for Hinkley Point C when it starts generating, So the construction risk is taken by the contracting party, EDF and its consortium.
Yeah.
With this one, there will be effectively our payments by consumers as we go along.
Yeah.
So the amount that needs to be borrowed by funded by the developer should be less,
yeah.
and should therefore have a lower cost of capital, and should therefore, in the long term, cost the consumer less.
Yeah. Yeah. Well, I think the issue, as you say, certainly in terms of, well, I guess there's the wider controversy about supporting new build nuclear, but also the fact that the consumers are paying for an asset which doesn't exist yet, and it's a clunky way of funding. So yeah, I mean, this is the first asset to be developed in this way.
Yeah.
Yeah. I mean, obviously there's the
in the energy sector,
there's the Thames super sewer.
Yeah.
I can't think what it's called now, but yes, there's that. Yeah. So there's also potential for integrated regime for onshore and offshore electricity networks, so an integrated regulatory regime. And yeah, finally, looking at revising or refining the smart meter installation targets, obviously given that the timescale for rollout has been.
For those suppliers that remain,
yes,
of course.
Yeah. Yeah, I mean, I think that's everything for power. Looking then at heat and building, I mean, obviously we had the heat and building strategy, which we'll see a little bit more on. I think probably the I guess the two big ones, which certainly caught my eye, was the comments on the rebalancing of policy costs from power to gas. Conscious that this is something which has been, I mean, it's been rumbling now for, it feels like the better part of a year.
Yeah.
In terms of whether or not there is a need to change the way in which policy costs are actually levied. So whether that's, I appreciate a lot of that has been upon moving into general taxation, but I think in the context of the power versus gas differential, how that's going to work, and the extent to which that effectively increases the cost of gas, thereby incentivizing move towards other heating technologies.
Colleagues at Cornwall earlier in the year did an insight paper where they looked at the balance of policy costs between the electric bill and the gas bill, and modelled some incentives from beginning to move renewables policy costs into the power bill. Of course, in the business sector, we are seeing this effect at first hand, because the climate change levy is in the middle of being equalised basically on an assumed carbon basis across the two main fuels, electricity and gas, and that is significantly upping the rate of the gas levy, while strangely not doing very much to the electricity rate, levy rate at all. No, so the net is it's going up.
So our syndrome, but it was originally anticipated that CCL on electricity would come down and gas would go up, and they would meet somewhere in the middle.
That's not what happened. Of course, no doubt the government would say that's because it's also phasing in the cost that used to be charged under the old CRC scheme.
Yes. I guess among a lot of people, completely forgotten that the CLC was still being integrated. But yeah, that's very much like first-hand example of it.
I think the consultation on the market-based mechanism for low-carbon heat is an interesting one. It looks like it's going to draw in manufacturers to obligate them to start to deploy, effectively, I'd imagine, non-gas boilers in their work, in much the same way that the renewables obligation obliged suppliers to buy electricity from renewables sources way back when.
Yeah, I think I guess that in conjunction with the consultation on phasing out fossil fuel heating from 2024 in non-domestic buildings as well. It does give you that time-banded approach to it, because the corresponding domestic one is 2026, and
the non-domestic ones are a little bit more opaque than it appears, because the penetration of gas and fossil fuels in non-domestic buildings is much lower than it is in the domestic sector. I mean, we're sat in an electrically chilled and heated office building, and that's where we are with the majority of new builds. So it's an interesting one, shall we say?
Yeah, I mean, I think appreciate that. This is like a little bit of a tangent, but there's a corresponding 2026 view for domestics, and that alongside the view of heat pumps and so on.
I mean, we're certainly talking to developers, Craig, aren't we, who are looking at all electrically heated district heating, and for big new low-rise and high-rise developments. So it's very strongly featuring in the thinking of the property sector now.
Yeah, very much so.
And that's where the thing at the foot there about basically a regulated regime for heat networks becomes very, very important.
I mean, I appreciate that there is a regulation of sort for heat networks, but it's not something that's akin to gas and electricity regulation under Ofgem, for instance. So I think that in conjunction with the market-based mechanisms sort of like gives you, I suppose, a very high-level conceptual steer as to thinking from government on this. Yes, that's transport. Again, we've got the existing policy form of the Department for Transport's decarbonisation plan. I think a lot of these commitments were, if not out in the public, then had certainly been foreshadowed by announcements relating to the sector. I think a couple of ones which did catch the eye were the additional funding for the rollout of EV charging infrastructure. I mean, I think that's now something like $2.5 billion overall to actually support that. And obviously, in the context of matters relating to network charging, network resilience as well, certainly very important. Very important one. I think so I guess like one of the other things that that caught my eye was the planned consultation next year on design and enforcement of emission mandates. So just trying to get a view on like what the actual rules of compliance will look like for the sector, because it's certainly clear that that these rules will be in place and they will be enforced somehow. It's a question of actually what that looks like. I guess you could say what the penalties would be for non-compliance. For hydrogen, yeah, I mean, as I said, it's hydrogen in this context. Well, certainly when I read through this, it seems to be like a little bit more almost of a sidestep for hydrogen, in that very much to focus on it's going to be used where it's not viable or practical to electrify. And admittedly, that's one part of it, but also the question of, okay, what's going to replace natural gas production from the North Sea? and the expectation that while hydrogen from electrolysis could do this, I mean, ultimately the growth is going to depend upon the growth in hydrogen is going to depend upon the depletion of the UKCS, the growth of renewable generation to offset decline in low carbon, higher carbon generation assets. The general potential or lack thereof for electrifying heat, and really the extent to which it's possible to undertake large-scale commercial trials of blending hydrogen with mains gas. So although there is that 5 gig target for 2030, I think the funding for hydrogen in the context of the overall amount of money which has been proposed under the strategy, it's less than $500 million, which I appreciate is a lot of money, but it's still it's a comparatively small amount.
When you think what's gone the way of EVs,
yeah, exactly,
so far, or indeed renewables over a long period of time on the electric side.
Yeah, so yeah, a little bit of an interesting wait and see one there. I mean, in fairness, that's also very much the same for greenhouse gas removals. This was something that Ofgem highlighted in the 2021 future energy scenarios as being needed, but still, as I said, due to the fact that a lot of the technologies are very much in development, certainly on a large-scale basis, the focus on the net zero strategy is essentially about facilitating proof of concept trials, and I guess a very much a targeted or focused basis. So you're looking at specific sectors in this rather than looking at it on an economy-wide basis. But there's a number of issues there. I think again, like one that caught my eye, and I think again this is me putting my economist hat on. It is looking at the options for how it's going to be regulated, what the reporting, monitoring, and oversight provisions are going to be. So still another area that's still very much up in the air. Yeah. So I mean that's the long-awaited net zero strategy. I think from what I remember, the amount of money which has been proposed under it is 26 billion across the board. So a lot in terms of the way of commitments, certainly with COP26 on the horizon. But as with all government policies, and certainly one of this scale, there's a lot of consultation to be undertaken, and additional documentations to come out, both in the coming months and well into 2022. Yeah, so given that I mentioned COP26, I think just looking at the, I would say looking at some of the announcements, I guess focusing more on one in particular, because there's been a lot, I think it's fair to say, that's come out in the last month. And the one that again, caught our eye was the issue on greening of finance, and really looking to build upon the reporting or the disclosure considerations that exist,
yeah, that's been a big feature in our forum discussions over the last year, hasn't it, Craig?
Yes.
How the UK is trying to take a lead in greening finance, and that's not just how we fund the investments. It's also the judgments that the investors make when they deploy their money, and that comes right back into the remit of the forum members who will be those with potential for investment wherever they sit in the economy.
Yeah.
So carbon disclosure and scenario-based planning for carbon emissions is becoming really, really important for at the moment for larger corporates, but yeah, signs that will extend as well.
Yeah, I mean, I think as you see, you've got a lot of products or propositions or offerings which exist from a financial perspective, which they or are marketed as supporting climate issues or environmental issues. Ultimately, what the government's roadmap does is it sets out, okay, if you're going to make that claim, then these are the criteria against which we're going to measure you or to benchmark you. And you can see there in the box on the right, the tests and the objectives that will underpin that. I think like one I know it's not on here, but one of the things that caught my eye is that this is being developed alongside the work of the government's energy working group, and they are looking at some of the more technical criteria. And I found it interesting that they've been asked to prioritise the role of new nuclear in that UK in that UK taxonomy. So I think that's another element, I guess, alongside what we said about the regulated asset base for nuclear, about whether or not that's.
Yeah, I think that's a really good point, because it shows it's not just the direct support subsidy frameworks that come into place. It's the the corporate governance, financial reporting and disclosure responsibilities that accompany it. And in many cases, we think that it's the latter rather than the former that will drive a lot of the changes of behaviour, particularly on the demand side of the market. There's not going to be the money to fund your changes. Either the reporting world will change so that you have to make those investments, and that people who look to provide you with that finance will be looking to see that what you are doing before they lend to you or before they buy your shares.
Yeah. I mean, I think that whole issue of shareholders being able to exercise their right to vote against what they see as unsuitable or unsustainable.
Yeah.
Corporate action.
Well, they'll become the bigger institutional investors will become mandated to do that.
Yeah, definitely.